I'm Sean Cooper, president and owner of Fit Financial Consulting LLC, and today I want to talk to you about one of the most important decisions you may end up making with regard to your financial success, and that's how to choose a financial advisor if you should choose one at all in the first place. Very much like choosing a personal trainer is incredibly important to your success in your fitness goals and your health goals, so too can choosing a financial advisor make all the difference in the world to your future financial success. It really begs a number of different questions, that being, should I even hire a financial advisor in the first place? If I do, which licenses do they need to have? Which designations and degrees are going to be helpful? What does their affiliation with the firm that they're with mean to me? And what other questions should I even be asking? My goal is to answer all of these questions, and because it's a ton of information, I hope you can bear with me because this is a rather long video, so I apologize for that, but let's jump right in. And the first question is really a personal one. Should you choose to hire a financial advisor in the first place? And the financial advisor, their purpose is often something of a psychological one in helping you avoid making irrational decisions that might be detrimental to your financial success. Additionally, they're there to help review the plethora of investment options that are available to you to help you make smarter investment decisions and smarter financial decisions along the way, and ultimately, hopefully, bridge the gap between that 3.5% average return of an equity fund investor and the average of nearly 9% return of the general market. So, when I look at this from a personal perspective, I think about it when I look at my car, and I typically take my vehicles into the shop to be serviced. Yeah, I could absolutely get the education. I can take the time to study, and I can break out a manual to figure out how to service my vehicles and how to repair them. But I also know it's going to take me 10 times longer than a professional, and I'm not going to be as confident that I did it right in the first place. On the other hand, I did take the time to fix my own water heater as well as my own clothes dryer. So again, it's really kind of a personal preference, and finding that balance as to what you're willing to invest in, and whether that's time or money. And if it's time, how much money or time can you afford to invest? So if you don't have time to evaluate the investment options that are available to you, to study them, to understand the different terms, and be able to construct an intelligent portfolio for yourself, you should absolutely talk to a financial advisor. On the other hand, if you do want to put in that time, invest that time, then by all means, go for it. But you should also ask yourself, if you've already been managing it yourself, how happy are you with the results? And I'm not just talking about the last 9 years, with the possible exception of 2018, but over the last 9 years, the domestic market's done pretty well. You didn't have to be a genius to do pretty decent over the last 9. But what I am talking about is periods like 2008. How did you do in 2008? Did you sell out of the market? When did you sell out of the market? Did you get back into the market? When did you get back in? If you're not happy with the answers to these questions, then you should probably talk to a financial advisor. Whether you choose to hire them or not, at least talk to them and see if there are better options out there for you. Once you've decided that hiring a financial advisor is right for you, there are a number of things you want to evaluate. The first is their licenses. So when I'm talking about licenses, I'm actually talking about baseline minimums. So the licenses really determine what products and services the financial advisor can even offer to you in the first place. So there's a couple of places to look. The first is going to be FINRA, the Financial Industry Regulatory Authority, and the second is going to be NASA, not to be confused with the Aeronautical and Space Exploration Group, but the North American Securities Administrators Association. So there's 5 different exams that I'm going to briefly cover here. The first is the Series 6, which is the Investment Company and Variable Contracts Products Representative exam. The exam measures the degree to which each candidate possesses the knowledge needed to perform the critical functions of an investment company and variable contract products representative, including sales of mutual funds and variable annuities. The second one is the Series 7 or General Securities Representative exam, which measures the degree to which each candidate possesses the knowledge needed to perform the critical functions of a general securities representative, including sales of corporate securities, municipal securities, investment company securities, variable annuities, direct participation programs, options, and government securities. Jumping over to NASA, the first one is the Series 66, the Uniform Securities Agent State Law Examination. The examination covers the principles of state securities regulation reflected by the Uniform Securities Act with the amendments adopted by NASA and rules prohibiting dishonest and unethical business practices. The examination is intended to provide a basis for state securities administrators to determine an applicant's knowledge and understanding of state law and regulations. Qualifies candidates as securities agents. The next is the Series 65 or Uniform Investment Advisor Law Examination, which is designed to qualify candidates as investment advisor representatives. The exam covers topics that have been determined to be necessary to understand in order to provide investment advice to clients. And the last one is the Series 66 or Uniform Combined State Law Examination, which is designed to qualify candidates as both securities agents and investment advisor representatives, so a combination of the Series 63 and 65. The exam covers topics that have been determined to be necessary to provide investment advice and affect securities transactions for clients. So those are the licenses, and like I said, these are kind of the baseline to determine what products and services an advisor can actually offer you. The next is to determine what knowledge base the advisor has. So take a look at what degrees they have. Do they have a undergraduate degree with a major in finance, an MS in finance, a MBA in finance, or a Master's of Science in financial mathematics? And whether they have these degrees or not, if you can, find out what classes they've taken. Did they take the bare minimum financial courses to skirt by and get the major, or were they a communications major? Or did they actually take some advanced financial topics that expanded their investment knowledge that can actually help you? Also, what designations have they sought to further expand their knowledge base? So a few of those that I wanted to cover as well, and we'll utilize Investopedia for that as a third party. You can actually find more information on each of these designations from the firms that actually offer them, but I find Investopedia to be a little less biased, maybe not completely unbiased, but a little less biased. So this is the alphabet soup of financial certification. So this is a good place to start. I'm going to go through a number of these that are more common from Investopedia, as I said, and just kind of jump through a sampling to give you an idea, and then you can look up additional designations on your own. The first is a Chartered Life Underwriter, or CLU, which is a designation for individuals who wish to specialize in life insurance and estate planning. Individuals must complete 5 core courses and 3 elective courses, in addition to successfully passing 8 100-question 2-hour examinations in order to receive the designation. Another would be the Certified Fund Specialist, or CFS, which certified fund specialists have received a certification from the Institute of Business and Finance, IBF, for their expertise in mutual funds and the mutual fund industry. Another is a Chartered Financial Consultant, CHFC. It's for a professional designation representing the completion of a comprehensive course consisting of financial education, examinations, and practical experience. Those who earn the designation are understood to be knowledgeable in financial matters and to have the ability to provide sound advice. Again, not completely unbiased, but these are to give you an idea. The Certified Financial Planner, or CFP, is a designation awarded to individuals who successfully complete the CFP board's initial and ongoing certification requirements. Individuals desiring to complete a CFP professional must take extensive exams in the areas of financial planning, taxes, insurance, estate planning, and retirement. The CIMA, or Certified Investment Management Analyst, this designation focuses on asset allocation, ethics, due diligence, risk measurement, investment policy, and performance measures. Chartered Alternative Investment Analyst, or CIA as it's pronounced, for CAIA, is a professional designation granted by the Chartered Alternative Investment Analysts Association to candidates who have completed Level 1 and Level 2 examinations. The alternative investments that a Chartered Alternative Investment Analyst is trained to assess include hedge funds, venture capital, private equity, funds of funds, derivatives, and real estate investments. And the last one I wanted to cover is the CFA, or Chartered Financial Analyst designation, which is regarded by most to be the key certification for investment professionals, especially in the areas of research and portfolio management. It requires passing 3 rigorous 6-hour exams over the course of several years, and according to the CFA Institute, that at least students study at least 250 hours in order to pass, although I believe the average successful candidate actually studies closer to 300 hours, and even at that, each exam has only about a 40% pass rate. But again, this is just to give you an idea of some of the designations out there. There are a plethora of other exam designations, and you can look those up on the company's websites, Investopedia, or even on FINRA to find out more about what those really entail. So once you have an idea of the advisor's knowledge, you also want to evaluate the relationship to the firm and what firm they've aligned themselves and what that could potentially mean to you. There are 3 basic setups for that. The first is going to be a bank, another would be a wirehouse or broker-dealer, and the last being an RIA, which is a registered investment advisor. And they really fall kind of along a spectrum, with banks typically offering the most control at the firm level, and RIAs, registered investment advisors, typically offering the most control at the individual advisor level. And again, then the broker dealers tend to fall in the middle of that spectrum. Again, though, this is just a general rule of thumb. You know, sometimes the banks can be very flexible, and there are certain RIAs that may be very controlling at the firm level. So that's just to give you an idea. But you do want to evaluate all 3 of them. So if we look at the bank, for example, there's a number of benefits. The first being ease. I mean, you probably have a checking account or a savings account at your bank, so having your financial advisor at the same institution can be very handy. Additionally, the banks tend to have size behind them, and this may offer a level of security as well as scalability, and being able to scale can often result in cost savings that hopefully they can pass on to you. And the last would be name recognition, which some people find very comforting, having a company that they can recognize the name to. Jumping back to that idea of control, though, it acts as something of a double-edged sword. The goal of having this additional control at the compliance level is in hopes of reducing the risk of unscrupulous activities at the individual financial advisor level, or investing in really poor selections, if you will. At the same time, it can limit certain investment selections, like I alluded to, potentially even alternatives or other asset classes that may reduce the risk of your overall portfolio or enhance the returns of your overall portfolio, but may be screened out just because the risk of these individual asset classes are too high on a standalone basis. The other aspect of control is with regard to proprietary products. So in many cases, banks or even broker-dealers offer what's known as a proprietary product. And if you're not familiar with those are products that are built in-house by the bank or the broker-dealer. And there are arguments for and against them, but one of the things I want you to be cognizant of is proprietary products can potentially lead to the firm not only making money off of the advice provided by their financial advisor that you're utilizing, but also making money off of the internal expenses of the proprietary product that they have sold to you. So can create something of a conflict of interest. But with that said, there are some proprietary products out there that are potentially excellent investment options that you may only be able to get and access through those individual firms. So just something to be aware of. As I mentioned, RIAs tend to be on the other end of that spectrum, with the compliance departments often offering more leeway to their individual advisors, hopefully with the goal of allowing them to create more customization, more customized portfolios, and more customized services to you, the end client. But it does create the added risk of a lack of oversight and an advisor being able to slip through with unscrupulous activities or getting into an investment that hasn't been thoroughly screened. In fact, in some cases, in the case of sole proprietors, they may be their own compliance group and providing their own oversight on themselves, which means you really need to be able to trust that individual. And we'll talk more about trust later, but you're going to be trusting this person with your assets, so you need to be able to be reassured that they're doing what's in your best interest, and we'll talk about that too. The other thing is the RIAs typically don't have proprietary products. That's not to say that none of them do, but it's typically less of a push, and there's often not any sales quotas or anything associated with them, so you don't have to feel pressured in that regard. They're more keen on open architecture investment platforms where they can offer you the universe of investment options and customize portfolios to you. The other aspect is really their size. Most RIAs aren't really that large, but even the ones that are, there are some out there that are managing billions of dollars in assets, tens of billions in some cases. But even if I provided you with a list of the top 20 in the country, you probably wouldn't recognize a single name on that list. And that size can result in less scalability, which technically can be interpreted as potentially higher fees. But what I've seen is it also results in fewer layers. So fewer middlemen that are adding in additional costs and additional fees that get passed on to the client. And ultimately what results is they kind of balance each other out. So the fees for an RIA are often very comparable to that of a broker-dealer or a wirehouse, and in some cases even less. But again, that's just another spectrum. The wirehouses and broker-dealers, as I've said, really fall in the middle of these spectrums across the board in terms of what we've discussed so far, but it is a spectrum that can be bridged. Some banks can be very flexible and some RIAs can be very inflexible, and some RIAs can be very large, and there are some very small banks out there. So how do you really tell what you're dealing with? And it's pretty straightforward on the front end based on the name. But the other thing you can do is just ask your advisor. Ask them what proprietary products they have. Ask them about their sales quotas, what their sales quotas are in relation to, and how they're compensated for selling proprietary products. That's good information to know and to understand where their interests are aligned, if you will. So after you've gone through and evaluated the firm that your advisor is tied to, you also want to make sure that your advisor has a clean record. So two places to go for that. The first is going to be FINRA Broker Check. Really what you're looking for on here, and this provides a ton of different information, including what licenses the advisor has, but the other thing you're looking for here is going to be any disclosures, any sanctions by the regulators, any penalties or restrictions imposed on them, and just really looking to make sure there aren't any black marks on their record. The other is going to be the SEC IAPD, that's the Securities and Exchange Commission Investment Advisor Public Disclosure. And this is very similar to Broker Check, except geared towards investment advisor representatives and registered investment advisors. So same basic concept, really looking for disclosures. You want to make sure your advisor has a clean background. The last thing I really want to talk to you guys about with regard to your advisor selection is going to be from the standpoint of how they do business. And that affects a couple of things. The first being how they get paid. So advisors get paid one of two ways. The first is going to be on a commission basis, meaning whatever products they sell you charge you a fee. That fee gets turned over to the broker dealer, and the broker dealer then pays the advisor. So they're getting paid a commission for selling you a product. The other is going to be fee-based. On a fee basis, you're actually paying the advisor directly. They're not getting paid by any of the companies they provide products to you for. So if we walk through those, talking about a commission-based advisor, the easiest way to look at that is on a mutual fund standpoint. So it applies to variable annuities and a variety of other products as well. But if we look at common mutual funds, share classes, the first is going to be an A share class. So A shares typically charge a front-end load of around 5%. And it does vary, but that front-end load is charged to you when you make the investment, paid to the broker-dealer, and then potentially paid out to the advisor in some percentage form. So what that means is if you invest $100,000 into a fund, really you're investing $95,000 and $5,000 is coming out as a fee. Additionally, that A share is also going to have annual internal expenses associated with the management and trading of the fund, and one of those internal expenses is a 12B1 fee that's in relation to marketing, if you will, and that is normally right around 0.25%, so 0.25%, and that also gets paid back to the broker-dealer and potentially paid to your advisor to some degree or another. On the other end of the spectrum in terms of share classes is a C share class. So C shares have a much higher internal expense ratio, and that's because that 12B1 fee is closer to 1% on an annual basis. So even though that's higher though, C shares do not have a front-end load, so you don't have that hit right up front. It's more of an ongoing fee. B shares, which are becoming less and less common, tend to fall in the middle of that range, excuse me, somewhere between that 0.25% and 1%. The biggest difference being, instead of having a front-end load or no load, they have a back-end load, meaning if you sell that fund within a certain time frame, you're going to be charged a fee for exiting that fund. Now, most B shares at this point, after that time period or maybe slightly longer, will actually convert to an A share class, so your 12B1 fee will go down over time. So just a few different ways that the commission-based realm works. As I said, on the opposite side is the fee-based realm, and they get paid directly by you, the client. The average fee for a fee-based advisor, I believe nationally, is 1.07%. So, and that's based on assets under management, or AUM. So you're charging them right around 1% for their asset management services and advice, as opposed to you being charged by the company that they sold you a product on. This also impacts the standard by which the advisor works with you. So within the financial world, there's actually a dual standard. The first is the suitability rule, or FINRA 2111. So FINRA 2111 requires that a firm or associated person have a reasonable basis to believe a recommended transaction or investment strategy involving a security or securities is suitable for the customer. This is based on the information obtained through reasonable diligence of the firm or associated person to ascertain the customer's investment profile. So this is on the commission-based side that you're dealing with the suitability rule, or FINRA 2111. On the fee-based side, you're typically going to be dealing with an advisor on a fiduciary duty basis. Now, technically speaking, the fiduciary duty is a more stringent rule. Unfortunately, it is less well defined within the financial industry. Technically speaking, what it entails and dictates is that an advisor put the client's interests first at all times, meaning they have to put the interests of the client above their own. From a legal perspective, the fiduciary duty is the highest obligation that one party can owe to another party. But again, it's not as well defined within the financial advising world, which is part of what the DOL was dealing with earlier this year and never really came through. So with that said, you probably want to know which one applies when, and you won't. Sometimes it's hard to know, but for the most part, it's fairly simple. So registered investment advisors, investment advisor representatives, and any fee-only advisor, meaning they only get paid a fee for working with you, are going to be operating under the fiduciary standard. Okay. Fee-based advisors, not to be confused with fee-only advisors, fee-based can do it either way, will be under the fiduciary duty when they're dealing with you on a fee basis, but they will be typically on the suitability rule when they're dealing with you on a commission basis. So a bit of a difference there. And to really give you a better idea of what I mean by that, commission-based advisors typically will work under the suitability rule, so FINRA 2111. The exception to that is when they're working with an ERISA qualified plan. So think 401ks and 403bs. So the Employee Retirement Income Securities Act of 1974 requires that all advisors, commission-based, fee-based, it doesn't matter, when working on an ERISA qualified plan, act as a fiduciary at all times for the clients in relation to that. So it doesn't apply to IRAs or Roth IRAs, just to the 401ks or 403bs. Again, that was something the DOL was trying to get incorporated in there, but didn't actually happen. Once you've gone through all of this, you've checked all the boxes, you understand their licenses, their designations, their education, their firm, and their clean background, how they're going to operate with you, and you're comfortable with all those things, the last thing is more intuitive. You have to decide if this is someone you like and trust. I talked about trust earlier. This is literally someone you're going to have to trust with your life savings, and you're going to have to trust them enough to disclose your entire financial situation for them in order for them to make an educated recommendation and a knowledgeable recommendation for your financial future. So it's really that simple. Is this someone you like and trust and really enjoy working with? Because you're probably not going to share all of your information if you don't even enjoy being in the person's presence. But I know this has been a long video and I've covered a ton of information. So if you have any questions, by all means, give me a call. My number is 720-808-6979. And my email is sean.cooper@fitfinancialconsulting.com. Thanks.